Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. I'm Kishore Muktinutalapati, equity strategist for ADCB. On this show, with an objective to empower you with investment insights, my colleagues and I will be discussing various perspectives shaping the global investment landscape. Let's dive straight into this week's content. Ian Fleming's James Bond is known for his resourcefulness. Yet, often we see him captured by antagonists who, with an intention to eliminate Bond, bids him a farewell. Goodbye, Mr. Bond. But as the story goes, Bond makes a miraculous comeback. Mr. Bond lives. Does that sound familiar? Similarly, over months we heard and read concerns that the bond market is dead, given very low yields these instruments had to offer. We disagree with this view and think that bond instruments still have a key role to play in the multi-asset portfolios. However, fixed income investment landscape is vast, and knowing what to own and what not to is more important than ever. To give us more insights on the fixed income landscape, I'm joined today by my colleague Prerana Seth, fixed income strategist for ADCB. Prerana, welcome to this show.
Thank you, Kishore, for having me here.
Prerana, why don't you begin by giving us a big picture view on the current situation in the bond market?
Fixed income assets have been under pressure recently, with market participants digesting more hawkish messages from the developed market central banks against the backdrop of inflation worries and growth slowdown concerns. The 10-year US Treasury yields, which were relatively range-bound during the third quarter, have now jumped after Fed's green signal on taper at the September FOMC meeting, and in fact now are trading near 3-month highs. The yield curve has fairly steepened, with the taper signal coupled with rising inflation concerns leading to a faster rise in long-term bond yields. However, despite the steepening, the front-end bonds have not been entirely immune to the sell-off, as markets continue to remain aggressive in pricing the Fed rate hikes. We believe it is too early to project that the Fed rate hikes will immediately follow the taper, given the underlying uncertainties related to COVID-19, a possible wave during the winter, and also peak global growth concerns. In fact, the Fed taper could provide some wiggle room for the central bank to address the next downturn, which could be earlier than anticipated given the pace of the current economic cycle. However, we expect the long-term bond yields to remain volatile until there is more clarity, especially on the inflation front. And addressing these concerns, we recommend holding a short duration stance on US Treasuries versus the global bond benchmark index by remaining overweight on the 5-year intermediate bonds.
Given those taper risks that you talked about, Prerana, what's the outlook for emerging market bonds broadly?
With the upcoming taper risk, we believe that within emerging market space, local currency bonds could be the most vulnerable, as the taper announcement could fast-track the policy normalization process of various emerging market central banks. Emerging market central banks which have lagged behind are likely to catch up, especially countries where commodity price inflation, despite likely to be transitory in nature, could start leading to second-round effects. We believe that LATAM could be the most susceptible to taper-related risk, even with the central banks there taking a proactive approach in policy normalization. Asia, on the other hand, could be less impacted as China will remain accommodative, addressing the growth concerns. Addressing these concerns, we recommend going underweight on emerging market local currency bonds from our previous neutral stance, while remaining neutral on emerging market dollar sovereign bonds. Emerging market dollar sovereign bonds could also come under pressure due to the stronger dollar prospects, but we believe that the pain could be less due to the recent decline in their correlation with the US Treasury volatility. We agree that the valuations have tightened in emerging market dollar sovereigns, yet they are relatively cheap versus emerging market local currency bonds. There are selective opportunities in the BBB and BB rated space, and we remain positioned through our selective overweight on Russia dollar sovereigns and Brazil dollar sovereigns respectively. In addition, we prefer high quality emerging market sovereigns, and the GCC region stands out the most. We express caution in adding new positions in the low rated emerging market sovereigns, as these could come under pressure with the potential taper risk.
From a cross-asset perspective, we've recently turned more positive on Asia. For instance, on the equity side, we upgraded Asia Pacific equities to a small overweight, and you on the fixed income side held emerging market Asia investment grade corporate credit at an overweight too. Against this backdrop, how are you seeing the evolution of the situation with China's real estate sector and the default concerns there?
The third quarter has been quite challenging for Asia credit, with the default concerns of China property developer Evergrande pushing spreads wider. While Evergrande falls in the Asia high yield segment, where we do not hold a position, market fears have led to the widening of Asia investment grade spreads as well. Despite the recent China regulatory concerns, we retain our preference for Asia credit through our overweight stance on Asia investment grade bonds. In the near term, we expect Asia high yield to remain under pressure, with China contributing almost 50% and real estate sector holding the largest weight in the Bloomberg Barclays Asia ex-Japan High Yield Index. Asia investment grade, on the other hand, will be relatively less susceptible, with government-related agencies holding the largest weight, but not completely immune, as the agencies could also have exposure to bad debt in the real estate market. However, it is crucial to look past the recent volatility, as a regulatory crackdown through the China's 3 red line approach is a credit positive move. Also, credit impulse in China has started showing signs of bottoming out, with the authorities taking an accommodative stance to prevent a liquidity crunch. Growth slowdown concerns, which have been excessively priced by the market, due to which valuations are looking cheap in Asia investment grade space. Beyond China, it is also very important to look at the growth outlook for the region as a whole, which is also set to improve with the better control of COVID-19 situation.
Well, that positive note is perhaps a good point to end. Prerana, thank you for joining me this week.
Thank you, Kishore.
Thank you for listening. In case you'd like to get more information on what was discussed on this podcast and what all this means to your investments, please visit our website at www.adcbam.com or reach out to your contact at ADCB. Also, please subscribe to this podcast on the ADCB YouTube channel or wherever you listen. Thank you once again. My name is Muktinutalapati, Kishore Muktinutalapati.